All right, thank you to Bob for filling in Brett's absence. I am pleased, back by popular demand, I am pleased to introduce Anirban Basu. He is the chairman and CEO of Sage Policy Group, an economic and policy consulting firm headquartered here in Baltimore. He was appointed chair of the Maryland Economic Development Commission. He also serves as chairman of the Baltimore County Economic Advisory Committee, the chief economist to the Associated Builders and Contractors, the chief economic advisor to the Construction Financial Management Association. He lectures at Johns Hopkins, and he has been selected as one of the 50 most influential people in Maryland. Please help me in welcoming Mr. Basu.
Right. So we're going to talk about the economy today, and very interesting times to talk about the economy. Thank you for continuing to host this. It's an indication that society is still functioning to a certain extent, and that we're still willing to be in one another's presence. I've entitled the presentation today, Return of the Economist. It's a Lord of the Rings themed presentation. The Dark Lord is clearly at work, and Lord Sauron. I say Return of the Economist because we did not have a recession in this country during the previous decade. And when the economy is doing just fine, you don't really need an economist. The best they can do is ruin your mood by reminding you that it won't always be this way. I presume that during the current decade we'll have a downturn or two, probably sooner rather than later. We'll talk about that. And so in that context, perhaps economists become a bit more salient. Now, there's lots of ways to start a meeting. Some start it with prayer, some with a Pledge of Allegiance. Sometimes you'll hear the national anthem, sometimes from multiple countries. I'm a big fan of the ring verse, which says, 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness bind them. And that's the way I've organized this presentation. 9, 7, 3, 1. 9 rings for the kingdom of men and women, 7 for the dwarves, 3 for the elves, 1 for the dark lord. And I'm actually going to start out with some good news. The fact that, yes, this coronavirus, this COVID-19 novel coronavirus, appears to be sort of the immovable object, but it is in some sense hitting what had appeared to be an irresistible force, that there was momentum coming into this period. And indeed, we got a report today from the Bureau of Labor Statistics regarding initial unemployment claims for the week ended March 7th. And initial unemployment claims for the week ended March 7th were 211,000, which was down 4,000 from the previous week. In other words, fewer people lost their jobs. Now, I'm not going to say that, I'm not suggesting that's going to continue, but that is an indication of the fact that there has been momentum running into this immovable object. And much of that momentum hails from the U.S. job market. And because it's been so difficult, so challenging for people to recruit talent, my guess is that you might not see in many industries, or at least among many employers, a lot of layoff activity very quickly. They've worked very hard to create these staffing models. They've been wrestling with skill shortages for years now. There are many unfilled positions in this country. In fact, according to the most recent data, 6.4 million available unfilled jobs in America. How many unemployed people do we have in this country? 5.8 million. Now, the circumstances are going to change. But through February, when the nation added 273,000 jobs, and I'm showing you monthly job creation here, we had 277,000 jobs in January. And you might say, well, that's irrelevant because we are now on a new economic trajectory. I don't disagree. It's partially irrelevant. But a lot of people are working right now. We have added jobs for 113 consecutive months in this country. Over those 113 consecutive months, we've added 22 million net new jobs. Unemployment at 3.5%. You'd have to go back to December of 1969 to find unemployment as low as it is today. And just to give you a sense of how long ago that was, the Oreos were good back then. So that was a long time ago. Economists have been predicting slowing job creation for quite some time, well before coronavirus. Why? Because with each and every passing month, it's been more and more difficult to find available workers to fill unfilled positions. But it hasn't happened. You can see the monthly jobs growth data here. We started the year off in raging fashion. America over the past year has added more than 2.4 million net new jobs. So this is for the one-year period, and my titles are not showing up on this computer. My titles are not showing up there either. Why is that? Can you see my titles? Font, you think it's font? So this is the, well, don't worry, I know what this is. This is the number of jobs created by each of these major industry categories for the 12-month period from February 2019 to February 2020. So what I'm saying is, over the last 12 months for which we have data, education and health services, that one category is added 673,000 net new jobs. Professional business services, 405,000 jobs. If you do the very simple math with the education health services category, it means that that sector by itself has added more than 50,000 jobs on average per month. It's a titanic total. Construction has added over 200,000 jobs, which is a minor miracle. Because anytime you speak to someone who operates a construction firm, even before they say, hello, good morning, I'd like to bump your elbow, they're like to say, I still can't find electricians. I can't find plumbers. I cannot find heating and air conditioning professionals. I can't find roofers. I can't find glaziers. I can't find superintendents. I sure as heck cannot find estimators. Trucking firm operators will tell you, I can't find truck drivers. Everyone knows that. I can't find mechanics either. Manufacturers will tell you, I can't find machinists. I can't find welders. A good welder in this country can make low six figures. So there's that momentum that is there. This is for the Baltimore metropolitan area. Again, this is for Boston. Again, some of the data are hidden, but you see enough of it. This is for the Boston metropolitan area. Boston, over the last 12 months, adding more than 36,000 net new jobs, 1.3% of job totals. This is New York. New York Metro adding 97,300 jobs. Why do we care about this? This is the fuel for the apartment market. This is what creates the renters, the leasing opportunities. And to the extent that it's industries like professional business services, and even government to a certain extent adding the jobs, that means some of these folks can afford enough to buy, or I should say rent, in new construction. Of course, much of the story has been about new construction. We'll talk a lot about that. Here's Baltimore. Baltimore Metro adding 27,800 net new jobs over the past 12 months. 1.9% job totals. I know Baltimore gets a bad rap, and much of that's deserved, but this economy has been one of the strongest on the East Coast for the last couple of years. Much of the strength, as it turns out, in the metropolitan area here is in the suburbs. So you can see it in the number of cranes in Towson, Maryland, for instance, the county seat of Baltimore County. You can see the redevelopment of downtown Columbia. But you can also see it in parts of Baltimore, including downtown Baltimore. This region, adding the bulk of jobs in Maryland over the past 12 months. Really quite strong performance. This is, again, percentage job growth for the 25 largest metropolitan areas in the country. Again, my title is missing for some reason, but this is percentage job growth for the 25 largest metropolitan areas in the country for the 12-month period spanning from December 2018 to December 2019. So if you ask me the question, Anirban, over the last 12 months, which we have metropolitan area data, which region of the country added jobs the fastest over that 12-month period? Dallas. Now, Dallas has been around for a couple of hundred years. They added 3.4% to their job totals in just 1 year. Dallas is booming. And, of course, employment growth is driven largely by population growth. So, not coincidentally, during the most recent calendar year for which we have population data from the Census Bureau, no region of the country added more people, more human beings, than the Dallas metropolitan area. That economy is booming. And you will notice that each of the markets in the left-hand column, the markets with the faster job growth, are markets that to the south and the west. Dallas, Orlando, Phoenix, San Antonio, Seattle, Houston, Charlotte, Atlanta, all south or to the west. Denver to the west, San Diego southwest, Tampa southeast, so on and so forth. The northeast and the upper Midwest are in the right-hand column, led by this town of Baltimore, that 1.9% growth, followed by other East Coast cities you can see here, Washington, Boston, New York, and Philly, all bolded for you. And bring up the rear three Midwestern markets, Chicago, Minneapolis, Detroit, no surprise. Despite the fact that I'm in the good news part of the presentation, I have to note that there were some segments of the economy that have been quite weak recently, including in 2019. manufacturing and agriculture, two of them, trade wars, strong US dollar, weaker global economy, frustrating the export sector that implicates manufacturing and agriculture in particular, and that also implicates the industrial markets of the upper Midwest, Chicago, Minneapolis, and of course Detroit. Minneapolis has a perfectly fine economy, don't get me wrong, home to companies like Best Buy, Target, 3M, Cargill, General Mills, US Bank, United Health, so on and so forth, with the Mayo Clinic down the street. But in an environment in which manufacturing and agriculture are weak, that economy is not going to perform nearly as well. But the story, I'm complicating this excessively. The story here is pretty obvious. Job growth has been pretty rapid in metropolitan America. I'm sure you can find many small towns that have been left behind by the expansion, certainly many rural communities. But in metropolitan areas, large ones, that's where the magic has been. Why? Because those are the places where people have moved. The most mobile members of our population are recent college graduates. The recent college graduates are most likely to shift residential address in any given calendar year. And there are certain markets that are magnetic from their perspective. Some of the markets that are magnetic from their perspective are not on this list because this is the 25 most populous metropolitan areas of the country, but it includes Nashville, Salt Lake City, so on and so forth. But that's where the action has been. And so when you've got so much job growth, you're going to have lower rates of unemployment. I'm sorry you're not seeing my titles because I actually spent quite a bit of time making my titles clever and Lord of the Rings themed. But this is 3 rates of unemployment here. In blue is male. And again, you can't see the dates on the bottom, but this is 20 years of data. Blue is male, the green is women, and the red is overall. The middle of the slide there is the downturn, the economic downturn, 2007, 2008, 2009. And you'll note that at that time, unemployment among men is rising faster than among women. That's because men tend to be more likely to be wedded to cyclical industries like manufacturing and construction. 70% of all manufacturing workers in our country are men. 87% of all construction workers in our country are men. A recent survey found that, by contrast, 92% of all nurses in America are women. Not to say that female unemployment didn't rise during the downturn, of course it did, but male unemployment rises faster. But that was many years ago. Unemployment now among the two major genders converging at around 3.5%. And what that means, you see that in the metropolitan area, unemployment rates are low throughout metropolitan area America. In Boston, 2.1%. In Miami, 2.2%. In San Francisco, 2.2%. Why so especially low in those markets? Because no one can afford to move there. The idea that you could graduate from college and then rent an apartment in Boston paying 1 month's rent and security deposit, impossible. So one of the things that we are noticing, and you've probably noticed this too, is that people have been moving to adjacent metropolitan areas. So I can't afford Boston, I'm moving to Providence. I'm moving to Hartford. I'm moving to New Haven. San Francisco has become so expensive that I've heard that some people are actually willingly moving to Sacramento. That just gives you a sense how expensive San Francisco has become. But the point of the slide, again, I'm overcomplicating things. The point of the slide is very simple. Unemployment is low everywhere in metropolitan area America. And so what does that do? That drives wages higher. This is the Employment Cost Index. ECI stands for the Employment Cost Index. Wages climbing the fastest pace in about a decade in America. Again, very clever title associated with this, but you will never know it. But and now you might ask the question, Anirban, you just said that we have a 50-year low in unemployment. Why do we not have a 50-year high in the pace of wage growth? I note, for instance, on the slide, your slide, that wage growth was faster during the previous economic cycle, the cycle of the 2000s. So what's going on here? Demographics. So one of the aspects of American economic life is the retirement of baby boomers in large numbers. Many people are compensated as a function of their tenure on the job. So if you think about local school teachers or sheriff's office people or so on, deputies, so on and so forth, they get their step increases from year to year to year. They get their occasional cost of living adjustments. And so the longer they've been on the job, the more money they make. But now they're retiring in large numbers, those more senior workers. And they're being supplanted often by millennials and Generation Z. Generation Z now entering the workforce, the children of Generation X. The Generation X known as the baby bust generation, so Generation Z is a smaller generation than the millennials. In any case, and this will have some salience later, but in any case, when you average out high salaries and average in lower salaries, fewer step increases, so on and so forth behind them, those younger workers, you're going to get this suppressing effect in the wage data. But still, the best performance in roughly a decade, and you can see this anecdotally as well. Might I remind you that Amazon, which is going to be quite busy in the months ahead, Amazon is not a 501c3. They are not a charitable organization. They're for profit all the time. So when they raise their minimum wage to $15 an hour, it is not for charitable purposes. And it's important to note that they operate throughout the country in places where $15 an hour is a big deal. Why would they raise their minimum wage to $15 an hour? Because they know, or they have known, that absent such bold action, they would lose their best and brightest workers to the fulfillment centers, and they cannot afford that to happen when they're about to deal with a lot of people ordering things to be delivered to their home, and also when they're trying to move towards same-day delivery. Bank of America, as it turns out, not a 501c3, not. They're for profit all the time, publicly traded. And they're actually busy helping people refinance mortgages right now, so on and so forth. But why raise their minimum wage to $20 an hour? That's quite a commitment because same reason. They're introducing new technologies into their operations. They need people who are savvy enough to deal with those new technologies, and so they raise their minimum wage. It's a recruitment tool. And workers at every firm have heard about these things. Oh, Amazon's minimum wage is $15 an hour. There was once a reference point. The federal minimum wage was the reference point, as it turned out. That's $7.25 an hour. It's irrelevant. In this state where you're sitting in today, the minimum wage is $11 an hour, rising towards $15 an hour eventually. All of this is symptomatic. I mean, through it all, we've still managed to add a ton of jobs. So what I'm trying to say here is that more people are working, more people are making more money, and so they're shopping. Now, this slide is entitled "In the Baggins," as it turns out. This is consumer expenditures in the bag. You see how clever that is? You actually can't see it, but it's clever. And what it shows is just consumer expenditures, services and retail goods. And if you look at it, again, there's a time series here, it's almost parabolic in terms of its shape. Again, is it an irresistible force, meaning with this coronavirus? We'll talk about that in a moment. But this is 68% of your economy right here. 68% of the economy is consumer spending. You say, Anirban, okay, fine, you're showing consumer expenditures here. What about retail sales? This is retail sales. Same thing. Oh, my title is right there. Look at that. Clever. Unfortunately, this turns out to be one of my least clever titles. But the point is, this is retail sales, and same thing. The consumer is still wanting to spend. And, of course, one of the things that's going to happen is lots of Grubhub, a lot of DoorDash, a lot of people ordering in food, as long as the people are willing to deliver that food right now, because, yes, and I've heard the term already, social distancing this morning, and there's going to be a lot of that. And so some of this activity perpetuates even through the coronavirus. Here's the miracle right here. Here's the miracle. This is a graph of inflation as measured by the core consumer price index. Measure inflation. I don't know, I should have checked this, obviously. I loaded my presentation on the computer, and the fonts obviously got messed up. But this is inflation. And I have to tell you that much of the last 2 years as an economist, I've spent unlearning economics. Because I had been taught in school, as many of you had been taught in school, that when unemployment falls, inflation goes up. It's called the Phillips curve, very simple. I don't know if that's macroeconomic first lecture, second lecture, but it's very basic. Unemployment falls, inflation goes up. And economists put forth such theories not simply because they make intuitive sense, of course, but because, sure enough, when you test such hypotheses against the data, with every passing economic expansion cycle, when unemployment falls, sure enough, inflation rises, holding constant all other variables. And so you would think that with a 50-year low in unemployment, with 6.4 million available job openings and only 5.8 million unemployed, with states and localities raising minimum wages, with Amazon and Bank of America and Walmart and so on and so forth with their own minimum wages, that we would be seeing more inflation by now. But according to this very broad measure, the core CPI, the core consumer price index, inflation over the past year has been running at 2.3%. And that's just a bit above the Federal Reserve's 2% target. We don't have a major inflation problem in America. That's the miracle. Because we should have more inflation by now. I remember many people, When the Federal Reserve was expanding its balance sheet from $800 billion pre-crisis to $4.5 trillion at its peak, many people said, they're printing money on Ebon, we're going to get inflation, where is it? And among the people who must be happiest about this performance are, in fact, the folks at the Federal Reserve Bank of the United States, the folks who fashion our monetary policy. For they have a dual mandate, which is to strive for full employment, meaning low unemployment, and contain inflation. Check, check. Our Federal Reserve Chairman is Jerome Powell, a continuous newsmaker, and he'll be in the news a lot in the next few days, I can assure you. He made some news, as it turns out, in late 2018, when he conducted an interview with a very prominent and proficient interviewer named Judy Woodruff. Perhaps you've heard the name. And during that interview, our Federal Reserve Chairman said, Judy, we at the Federal Reserve have been raising interest rates in this country since December of 2015. By December of 2018, we will have raised interest rates 9 times, and our intention is to continue to raise interest rates into 2019. And you may or may not remember this, I suspect you do, that in late 2018, the stock market was reeling. It's reeling this morning, as it turns out, but it was reeling then as well. And why was it reeling? It was reeling for a couple of reasons. There was about an impending federal government shutdown that actually would begin in December of 2018. But the big factor was that interest rates were going to continue to rise. The Federal Reserve was going to continue to tighten monetary policy. And generally speaking, that's not good for stock prices. It raises the cost of capital, slows economic growth. That's not good for corporate America. So the stock market was tanking in late 2018. And the president heard about all this, and he tweeted. He tweeted aggressively. He tweeted, I don't think raising interest rates is such a great idea. I don't think it's good for the U.S. economy. I don't think it's good for the American people. Question, can I fire Jerome Powell? Legitimate question. It's not clear whether he can or can't. And I'm pretty sure it's pure coincidence. But during his next set of interviews, our Federal Reserve Chairman said, you know what? We're not going to raise interest rates. We're not going to do that. Who would think to do such a thing? That's crazy talk. You know what we might start doing, in fact? We might start cutting them. But what allowed the Federal Reserve to engage in a 180-degree policy pivot during the early weeks of 2019? Well, right here, we don't have a major inflation problem in America. In fact, the Federal Reserve has a measure of inflation that it prefers to the core CPI. It's called the core PCE deflator. PC stands for personal consumption expenditures. Again, whenever I have a non-clever title, it shows up. I don't get this. But, and this measure of inflation, as it turns out, suggests that inflation is running at 1.6% year over year, below the Federal Reserve's 2% target. Hence justifying not 1, not 2, but 3 rate cuts that we experienced last year, none of which had been predicted by economists. And that sent the economy into a frenzy. That helped to really propel not just the stock market higher during the latter half of the year, but that's why we had so much momentum, one of the reasons we had so much momentum coming into this year. Now, the Federal Reserve, for negative reasons, as it turns out, coronavirus, has already cut another 50 basis points. So of the 9 rate increases that we saw between December 2015 and December 2018, 5 have been rolled back. Ultimately, they will all be rolled back. We're heading to 0% interest rates. It's the only thing the Federal Reserve knows to do. I mean, they have to do something, I suppose. So we'll have another meeting at the Federal Reserve in about a week or so, and expect more action from there. And one of the reasons they're able to take this action is because we haven't had major inflation issues. And we'll have fewer still now. I don't know if you noticed this morning, oil is down to $31 a barrel. Natural gas is below $1.80 per million BTU. Prices are crashing everywhere. Italy is in lockdown. You've heard that 60 million people. That's the 8th largest economy in the world. I mean, the global supply chain has already been fragmenting, and now, of course, there's going to be even more downward pressure. And so when you have low inflation, you have low interest rates. We economists make the mistake of talking about low interest rates as being purely benevolent. They're not. Certainly hard for retirees, hard for life insurers, others that are underfunded pensions. But if you're trying to propagate or perpetuate a growth cycle that's now threatened, and it's and a little bit old in the tooth, is exactly what you'd like. Now, this is the yield on the 10-year Treasury. Interest rates are hobbit-sized. 10-year Treasury, as I got up here this morning, is yielding 0.67% as I got up here. Why do we focus so much, by the way, on the 10-year Treasury? It's the most liquid bond in the world. What does that mean? So there's a news cycle, always. There's always something going on. 8 weeks ago was War with Iran week, for instance. Then the next 3 weeks were impeachments. There's always a news cycle. Then it was Bernie Sanders getting hot. always a news cycle. So if I want to all of a sudden say, oh, there's a news cycle that's not working in my favor as an investor, I want to de-risk my portfolio, what can I do? I can quickly purchase 10-year treasuries. Why? Because they're always for sale. When the news cycle passes, oh, it's going to be Joe Biden, then I can go back to the riskier part of my portfolio. And I can easily sell those 10-year treasuries because it's the most liquid bond in the world. But you can have too much of a good thing. The fact that the yield on the 10-year treasury these days is so low tells us what? People are scared. So scared. And they should be scared. But on the other hand, there are some people who benefit from this. For instance, folks who are trying to, this is mortgage rates as it turns out. Very clever title as it turns out, you can't see it. These are folks that are trying to, these are mortgage rates of interest. The 30-year fixed mortgage rate is in blue and the 15-year fixed mortgage rate is in red. Again, easy to forget, but the housing market was sort of shutting down, not the rental housing market, but the owner-occupied housing market was sort of shutting down in late 2018. Why? Because the 30-year fixed rose had the temerity to rise to roughly 5%. Now, many of us recognize that 5% from a historical perspective is quite low. There are probably some people in the room who got their first mortgage at 18%, 17%, maybe some over 20%. So 5% by that standard is low. But in a country that had become accustomed to 3.5% on the 30-year fixed, it seemed high. And the expectation was what? That mortgage rates would continue to rise as we entered 2019. Why? Because the Federal Reserve told us they were going to rise. They were going to tighten monetary policy. Why? Because we were at full employment and unemployment was still falling. Exact opposite happened. And so one of the effects of this has been, oh, this has no titling whatsoever. Believe it or not, this is home prices. This is the Schiller Home Price Index, and home prices have been on the rise. Can you imagine if I didn't know what I was talking about? I mean, I don't. I mean, I'm not saying I do, but at least I know what these slides are supposed to be. So, but this is home prices. And so what I'm saying is, what have we done so far? More people are working. More people are making more money. Their home values are rising. And that foments more construction. That's the way that's supposed to look. The kingdom is under construction. Home builder confidence recently was at a 20-year high. We saw a real surge in single-family permits. That's an intention to build. But when you talk to realtors who are trying to sell homes as opposed to lease apartments, when you talk to realtors, they'll say, look, it's great that I have so many people who have been looking to buy homes, take advantage of these low mortgage rates. I've got almost nothing to show them. Inventory of unsold homes is low because we haven't built much in recent years. So the home builder community, recognizing that opportunity, has been asking for permission to build more units, and we were on our way. Now, this is apartment construction. A few years ago, I'm quite sure when I spoke to you, I was concerned about apartment overbuilding. Now, I'm going to have to walk through this carefully. So you see the green bars here for every year? That's apartment completions. The blue bar is net absorptions. People move in, people move out of apartments, but there's a net figure there. You notice that in 2015, 2016, the green bar is above the blue bar. What does that mean? That means we were completing more units than absorbing. And at that point, economists were concerned, my goodness, it looks like there might be an apartment building bubble in this country taking place. Just building too many units, not able to absorb them all, we're concerned. You heard a lot of that concern a few years ago. And then what happened? The economy takes off. Pace of job creation accelerates. And you'll notice that by 2017, even Steven, the two bars, by 2018, we were absorbing more units than we were building, and the same thing for the 4 quarters ended more recently, 2019 Q4. We are in really quite good shape in terms of apartment building. In fact, look at this. So this is for 2019. This is new supply for these major metropolitan areas. So what I'm saying is in New York Metro, over the last year, we've supplied 30,100 new units. The next slide is absorption. How many did we absorb? 40,100 units. Look at Washington. Washington, 12,000 units delivered. How many did we absorb? 14,300. And so what does that lead to? It leads to lower, this is apartment vacancy or multi-family vacancy rates. Look at some of these rates here. In Sacramento, 2.7% apartment vacancy. I just said it a moment ago. People are moving to Sacramento willingly, but they're really not. They'd rather be someplace else. You've been to Sacramento. That's not the first choice. That's not it. Who grows up saying, oh, if only I could live in Sacramento. That's the dream. That's not the dream. Unless you're governor of California, that is not the dream. But Columbus, Ohio, 3.2%. I mean, it's fantastic. And what does that lend itself to? Well, more apartment construction, of course, because the market supply is constrained, but also rising rents. Now, New York is at number 12 here, you can see, at 4.3%. Washington at 5.2%. A lot of apartment deliveries. It takes time to absorb even in very strong economies. Baltimore at 8.1%. That's at number 37. A lot of apartment deliveries in this region, and it just takes more time, I suppose, to absorb some of these units. And this economy has been adding jobs in quite a few, at quite a significant rate very recently. So in any case, overall vacancy rate for multifamily 6.4% in the US. It's a healthy market despite all the construction. This is a measure of non-residential construction spending. So as defined by the US Census Bureau, there are 16 categories of non-residential construction spending in our country. These horizontal bars relate to the increase in construction spending for the 5-year period spanning from January 2015 to January 2020. January 2015 to January 2020. So what I'm trying to say is that construction investment in lodging, that's mostly hotel room construction, up 60% in 5 years. If you do the simple math on that, 60% divided by 5 to try to get a back-of-the-envelope calculation of a compound annual growth rate, very significant. Office space, 56.5%. Hidden from view here has been a real surge in infrastructure building, infrastructure construction, because state and local government finances have been in pretty good shape, so more spending on conservation development. That's mostly dams and levees, that's flood control. Public safety, that's construction of police stations, fire stations, jails, and prisons, so on and so forth. It's been pretty strong. You'll notice at the bottom, though, are some categories of construction that have lost some construction momentum. Manufacturing, again, trade wars, strong U.S. dollar, weaker global economy. And then religious, and that's your construction of churches, temples, and synagogues and mosques. That's down 9.7% over the last 5 years. God is down roughly 10% on a 5-year basis. I expect that to come back in April. And anyway. Here's the stock market, Remember that joke a few years ago? And by the way, I've indexed the Dow Jones on the right and the NASDAQ and the S&P on the left. And I get it, the Dow Jones is down more than 1,000 points this morning, and so on and so forth. So, we were down 22% on the Dow Jones coming into this morning, and we're in now bear market territory, and it's going to get worse before it gets better. I think people understand why. But it had been great, and so for a time there, again, this irresistible force, more people working, more people make more money, their homes are more valuable, their stock portfolios are more valuable. It's interesting, though, because I think you would agree that one of the vulnerabilities here was that the stock market was too strong. Its rise was inexplicable. So when you buy a share of a company, what are you buying? You're buying its discounted future corporate earnings. And corporate earnings have not risen in this country for 6 or 7 quarters. And it didn't matter for a time what the news cycle was. War with Iran, fine. Market went up. Impeachment, no problem. Initial period of the coronavirus. It's called COVID-19. Why? Because it was discovered in 2019. It's not that recent. But for a time there, the market was able to sail right through it, didn't worry. And so that speaks to a vulnerability. When things seem too good to be true, they probably are. When Warren Buffett and Berkshire Hathaway maintains $130 billion in cash just sitting on the sidelines, that's a signal that something's about to happen. They're not just sitting around with cash because they just like sitting around with cash. I mean, I like sitting around with cash, as it turns out. But they have got other people, investors, to answer to. No, they knew that something was wrong here, that there was some mispricing, that there's some factors that were dwarfing hope. Now, again, part of that, this is an index of manufacturing activity, the Institute of Supply Management's Purchasing Managers Index. You see the 50-yard line running west-east across that slide. Any reading below 50 means that this sector of the economy, manufacturing, is in recession. It was in recession for 5 months last year. Then what do we get? It was going to be great. This year was setting up to be fantastic economically. It really was. We get the first phase trade deal with China. We had ratification of the U.S.-Mexico-Canada Trade Agreement, the USMCA, or ASMCA. and we get some certitude regarding Brexit because of Boris Johnson's resounding victory in the UK. So all of a sudden, global supply chains were coming back to life. This index bounced back up to 50.9 in January before trailing down to 50.1 in February. Now with the coronavirus, of course, this is going to dip well below 50. This is year-over-year percentage change in manufacturer shipments. For much of last year, it was negative. But here's the big issue right here. Set this aside. A lot of people are looking right now at the forward-looking data. How many infections in Italy? What's going on in China? Angela Merkel saying that 70% of Germans could ultimately be infected. So they're looking at what's the future going to bring. How many more cases in California, Washington State? Yesterday in Baltimore County, we got our first case. I live in Baltimore County. I wasn't the person. But I think another way to look at this is look backwards and say, did we create some fragilities? And I think we did. And what is the leading source of fragility? And that's the word of the day, fragile. This economic expansion was marching forward. But it was like an army that was marching forward, but the wheels on the jeeps had become loose. And the gunpowder had become soggy. And the soldiers had become tired. And we had kept moving them forward. We threw caffeine at them. That was the tax cut. And we threw some sugar at them. That's the deficit spending and the interest rate cuts. But ultimately, they are a weary force. And now they're running into the enemy, and what looked to be very strong, in fact, had a lot of fragility built within it. And the leading source of fragility, indebtedness. This is the federal debt held by the public as a percentage of GDP. It's one of many ways to look at the national debt. And you can see what the projections are past 2020, that this deficit will continue to grow. The national debt recently screamed past $23.2 trillion. And one can make the argument that America, while growing, has been growing for all the wrong reasons. Let's do some simple math. Last year, the U.S. economy grows 2.3% in real terms, meaning inflation-adjusted terms. I just showed you a measure of inflation, the CPE deflator, the PCE deflator, the core PCE deflator, that suggests that inflation has been running at about 1.6% year over year. If we add those two numbers together, 2.3 plus 1.6, we roughly get 4%. So in nominal terms, the U.S. economy grew 4%. Let's do some more math. The federal budget deficit during the last calendar year, not the federal fiscal year, but the calendar year, was $1.02 trillion for the year. We, the American people, produced $21.7 trillion in economic output last year. So if you do the math on that, that means that our federal budget deficit equaled 4.6% of GDP. You take away that 4.6% federal deficit spending, there is no economic growth in America. And the expectation is that those deficits will persist. This is federal government deficit as a percentage of GDP, including into the future. Those darker blue bars are forecasts. That's what's holding this economy together. And of course, it's not just the federal government that's been taking on a lot of debt. So too has the American household. Here I'm showing you various flavors of household indebtedness. In orange is mortgage. Blue, as it turns out, is credit card debt. My label got destroyed there. The red is student loans. But in nominal terms, consumers have never been so indebted. Say, Anirban, but interest rates are low, so debt service is not problematic. You're right. For many families, debt service is not problematic. In fact, delinquencies on debt have been quite low, student loans notwithstanding, and credit cards among millennials notwithstanding. But now with more people about to lose their jobs, and they're indebted, what does that mean? They are fragile. And that fragility is really going to show up in the next few weeks, and then in the next few months. Corporate America, this is corporate debt. Corporate America has never been so indebted. You say, how could this be, Anirban? You just showed a slide showing that corporate profits have been growing over the course of years and have now stabilized at a lofty level. They're no longer growing, but at least they've stabilized at a lofty level. True. But this is what happens, this amassing of debt, when one buys back their shares every year. You issue debt to buy back the shares, debt goes up, equity goes down. My younger daughter, Kohena Basu, just turned 14 years old. And because she's 14, her favorite store at the mall, Claire's. Now, I don't know if you're familiar with Claire's, but there's still some pretty exciting merchandise, what the kids call merch. Earrings, hair clips, glitter, My Little Pony, cell phone cases. I shop there. And if you've ever been to a Claire's, it's always busy. It's a very successful enterprise. It's very successful. If you have young daughters, undoubtedly they know about Claire's. So how can they be in financial difficulty, Alibaba? Because several years ago, a private equity firm leveraged up Claire's balance sheet with the board's approval, trying to maximize return on equity. They don't have much free cash flow anymore. They're operating in bankruptcy. They went bankrupt in 2018. Forever 21 was a hot retailer just a few years ago, but what happened? They got leverage up their balance sheet. They just went bankrupt. Pier 1 Imports. Toys R Us. I've yet to meet a human being tell me, you know what? I did not like Toys R Us. I didn't like what they stood for, toys. I don't want to meet that human being. It's very difficult to have a business that is universally beloved and that one generation wants to share with the next. That's rare. So what happened, Anirban? Actually, before the Great Recession, a group of private equity firms came together, a consortium, to leverage up Toys R Us's balance sheet. So when the Amazon effect became apparent, they did not have enough free cash flow to fight back, to reposition that business. They were fragile. They look good on paper, but they're fragile. And when that competitive factor emerged, they couldn't make it. They didn't just go bankrupt, they were liquidated. So what I'm saying is what often looks strong superficially, underlying that is weakness. And that weakness in our case, the weakness of that army, this irresistible force, has been this massive underlying indebtedness at the government level, at the consumer level, at the corporate level. And it's a global issue. According to the International Institute of Finance, total global indebtedness exceeded $250 trillion by the early part of last year. It ended the year at around $255 trillion, equivalent to 320% of annual global output. We've never seen numbers like this. What are the Italians doing today, by the way? They're borrowing more money and pumping it into their economy to try to keep things going. But their debt-to-GDP ratio is 170%. It's well above America's. Japan's is around 250%. Ours is closer to 100%. But lots of indebtedness around the world. This gets at productivity. You can't see it here, but I entitled this slide Entish, because the Ents were the trees in The Lord of the Rings, are the trees in The Lord of the Rings, featured heavily in the second movie, The Two Towers. As a practical matter, trees don't move very quickly, and now apparently there's the American worker, because U.S. productivity has been growing at an average rate of 1.3% since 2007, compared with an average annual growth rate of 2.1% since the end of World War II. Growing up, what did you hear? Average annual growth potential for the United States of America is 3% per annum in real terms. What do you hear now? Average potential rate of growth in America is 2%. What's the delta? Right here, productivity. You could add on immigration policy and some other things that are slowing labor force growth. But so how have we kept things going? We've borrowed money, but we've not been growing for fundamental reasons. Labor force expansion, productivity growth. We've been growing because we've been willing to borrow money from the future and spend it today. Which means at some point in the future, we're going to have to, instead of spending money tomorrow, pay back the debts of today. And that's where we're at. Of course, there's always global economic uncertainty or policy uncertainty. This is the Global Economic Policy Uncertainty Index. You will note that late last year, uncertainty abated. Of course, we got the first phase trade deal with China. We got the ratification of the USMCA. We got some certainty regarding Brexit. But always uncertainty, and of course the coronavirus, because of the coronavirus, you'll see this spike again. But there's other things going on. There's still North Korea out there. There's still Iran out there. Earlier this week, they had 2 ceremonies swearing in the new president of Afghanistan. Problem, 2 separate presidents. So one was Ashraf Ghani, got sworn in, and a competing ceremony at the same time, Abdullah. You know what happens when 2 people claim the presidency at the same time. It's not pretty. So that's still out there, those kinds of things. This is believe it or not, this is the Shiller price-earnings ratio. This is stock market. So what I'm trying to do is compare the price of the stocks on the S&P 500 against the underlying corporate earnings. And I apologize again for the titles not being there. Not my computer, but anyway, I should have checked it. What I'm trying to say is, if you look at, coming into this period, we had very high asset prices. I think you'd agree. And you've seen this in the form of low cap rates and in other ways. You'd have to go back to basically the pre-dot-com bust period of 2000 to find meaningfully higher share prices as a function of corporate earnings. So again, that fragility. So now I'm going to go into the forecast, but I want to say just one final thing before I go into the forecast. Don't get me wrong, this last decade has been wonderful for the United States of America. For decades, America's share of global output declined on purpose. It was Americans who fomented the Marshall Plan to help rebuild Europe. Is Americans who spent their own treasure to help rebuild the Japanese economy, trying to turn our sworn enemies into our future trading partners, and it worked. Germany is today the 4th largest economy in the world. Japan is 3rd. But last decade, something strange happened. America's share of global output actually rose from 23% at the beginning of the decade to 25% by the end. We're pretty amazing as a people, aren't we? We're less than 5% of the world's population, responsible for a quarter of its output. And I'm about to say something that might sound sort of patriotic, maybe even cheesy, and maybe not appropriate for this audience, but I'm going to say it nonetheless. I think we Americans are the least messed up people in the world. And I know that comes off as a little strong and bold. I get that. And I'm not saying that we're not a mess. We are a mess. Don't get me wrong. With our debt and our unsettled immigration policy and our politics, we're a mess. Don't get me wrong. But the rest of the world is even a bigger mess. That's what I'm suggesting, which just goes to show you how big a mess it must be. Because our share of global output actually rose. But does this performance, which is quite remarkable given the history of the last few decades, justify this performance? This is stock market returns by country, 2010 to 2019. You can see United States stock market return last decade, 256%. India, for instance, 46%. A country that grows 5% during a really bad economic year in real terms. Emerging markets, 49%. So whether you're looking at absolute terms or relative terms, things were just too good to be true. Warren Buffett realized it. And now we're seeing it. I have been predicting recession for a few years, for around this period of time. And you can see it. I can show you my forecasts for the Baltimore County Auditor's Office or the Maryland Department of the Comptroller. We built into this year a recession. I'll talk more about that in a moment. But I could not tell you that what the triggering event would be. I could tell you there was a fragility, a vulnerability, that things were too good to be true. But I didn't know when it was going to end. And I have to say, I was shaken by the fact that we had so much momentum coming into the year. I was starting to doubt my own forecast. And one of the reasons I was doubting my own forecast is because there have been some things that have really defied prediction, that economic theory has gotten wrong. 3 things. So now I've done the 9, I've done the 7, here's the 3. Impossibly low inflation. How could one have seen this coming in the context of the lowest unemployment rate in 50 years, lackluster productivity growth, a robust consumer spending sector, and the lengthiest Spanish American history? We should have had more inflation by now. It didn't emerge. And now, of course, we have deflationary pressure spreading throughout the economy. Second thing I got wrong, incredibly low interest rates. How can global indebtedness be so high and global interest rates be so low? One of the other things I learned in school, as you did, is that when governments borrow a lot of money, that raises interest rates for everybody. You've heard of this notion of public debt crowding out private investment. Why does that happen? Because at any given moment, there are only so many people willing to lend in the economy. And if government's borrowing a lot of those lendable funds, it raises the cost of borrowing for everybody else. That's the logic. And global indebtedness has been surging for 4 decades now. Global interest rates have never been lower. In some cases, they're negative. And I have to tell you, I do not understand negative interest rates. I don't get it. And I'm not concerned about the presence of negative interest rates because I understand the implications of them. I'm nervous because I don't. Something I didn't study in school. This notion that you would put money with somebody and then pay them interest for the privilege of lending to them is foreign to me. But it's something we observe. And I think it's another signal that we've had this fragility, not just in the United States, but globally. And of course, we have not had negative interest rates yet in America. The strength of the U.S. economy itself has been somewhat surprising. How can the U.S. economy have been performing so well, and financial markets booming so splendidly until a Monday ago, in the context of fragmenting global trade, slower immigration, Brexit, impeachment, global warming, and other phenomena that one would think would be bad for domestic economic outcomes? It's been really quite splendid, hasn't it? But it is now, unfortunately, at an end. I think the recession's already begun. I think when all is said and done, the recession will be dated to have begun this month in March. Election year politics renders the response even more complicated. In some sense, it could not have happened at a worse time. It would be, look, it's a bad thing. People are dying. I'm talking about the economic and financial implications. Obviously, there are bigger implications than those. But there might be some folks, not to be partisan here, that's not my goal, but there might be some folks who are not that interested in having the economy be great in November. And there might be some other folks who may not want the economy to fall apart by November. And that might cause them to not want certain people to stop doing what it is they're doing, even though stopping what they're doing might be good in the context of public health. Anyway, this complicates the response. Recession will be short and vicious. My wife calls me that, as it turns out. And I think that will be the same for the recession. Certain industries will be hammered, and you know what they are: travel, leisure, hospitality, the energy patch. So we didn't see a lot of layoffs for the week ended March 7th. Watch for the week ended March 14th. See a lot of layoffs, especially on the U.S. energy patch, as oil prices crumble. Mass bankruptcies beginning because we've had all this leverage. And a lot of companies cannot afford 3 months of a cessation of activity, and that's what they're going to experience. They're going to go bankrupt. And financial market turmoil, of course, obviously. Because how do you price something like this when you don't know when it's going to end or how bad it's going to get? Global trade has already been fragmenting. It's fragmenting further, putting further pressure on the entire worldwide economy. Feedback loop is deeply problematic. But the recovery, when it arrives, will be dramatic. Expect a V-shaped recession and recovery. Stimulus is in the pipeline already. Ultra-low borrowing costs have people think about refinancing. And the need to replenish inventories at some point in the future will also help usher forth a period of very rapid economic growth. I don't know if it's later this year or early next year, but the recovery from this will be quite rapid. When Fiat Chrysler announced that it's shuttering its plants, what does that tell you? At Fiat Chrysler dealerships, what's going to happen to the inventories of unsold cars? They're going to fall and fall and fall. At some point, this is going to turn around. Consumers are going to have low interest rates. They're going to be looking for product, and all of a sudden the factories are going to go into overdrive to try to replenish that inventory. And it's going to be a lot of fun when we're on the other side of that V. But right now, we're at the early stages of this downward drift. It's going to be short and vicious. And for the apartment market, of course, what I would expect to see is less fuel for the fire, meaning less job creation. The first wave of labor market impact is not layoffs. We know that because it hasn't happened yet. The first wave is a cessation of hiring. It's going to be about cash preservation, cash management. So businesses are going to slow hiring. Government agencies are going to slow hiring. And that ultimately means fewer people looking at apartments. And then we're going to start to see some profound job losses. April, May, June, July. First part-time workers at hotels and restaurants, caterers, so on and so forth, in the energy patch. And then it'll penetrate more deeply to manufacturing, so on and so forth. Watch for that. Sorry, I wish I could have said something more upbeat, but that's my presentation. Thanks very much for the opportunity to be with you this morning. It has been a privilege. And we actually have some time for Q&A, as it turns out, based on the schedule. So I'm happy to try my hand at questions if there are any from this audience. Thank you for being here again. Sorry about the slides, but we worked through it. Any questions here from this audience? Any questions? It might be the last public gathering that you are in quite some time, so might as well take advantage of it. I mean, we're together, so any questions while we're outdoors? Yes, sort of. Right, so the question is about, how low can rates go before people are willing to, before people stop buying the underlying paper that support those low rates. Every time in situations like this, I have been surprised by how low rates can go before people are willing to stop buying the paper. And in a world in which there are negative interest rates, remember there are buyers for that paper all over the world, not just the United States. So I think 3% is, in my mind, an artificial barrier. It can go below that, and there'll still be demand in a world with negative interest rates, and in a world where the Federal Reserve is going to maintain a 0% Fed funds rate and a 0% discount rate. I think we can actually go lower than that, and there'll still be buyers for the paper. Because right now, what is the issue? There's no yield anywhere. And you don't want to be necessarily invested in the stock market right now. We don't know where it's going to go. Between 2000 and 2002, and then between 2007 and 2009, on each occasion, the Dow Jones, or I should say the S&P 500, as it turns out, fell 50% on each occasion. We're down 22% to date. A lot of, people know this. So I still think there'll be demand for that paper. I mean, yes, I think so, below 3%. Now, at some point, it gets ridiculous, and the demand will dissipate. And in fact, there's some discussion this morning already that certain credit markets are seizing up. There's a lack of liquidity in certain credit markets. I mean, in some sense, low interest rates hurt us. because we really need banks to lend, but what incentives do banks have to lend when these interest rates are so low? Why would I want to make a mortgage for 30 years at 3%? I'm taking the risk of inflation. Not the customer. The customer is paying 3% for 30 years if they survive the virus. But there will be some banks that will do it nonetheless. I understand that. But in terms of the demand for paper, I think the demand for the paper will be there. Yeah. Any other questions here? Yes, madam. Please. Okay, great question. So she understands the vicious part. She doesn't understand the short part. And I say the same to my wife because I'm taller than she is. But anyway, because we have the best and the brightest working on therapies and on a vaccine, because one of these days we're going to hear from Gilead, we have a therapy, or we're going to hear from Regeneron, we have a vaccine. Now, as it turns out right now, because so many people are already infected, the therapy may actually matter more than ultimately the vaccine does, in the short term at least, perhaps. But both would be very useful. And so because we've got the best and the brightest involved, because we had H1N1 in 2009, we got through that, and we got through Zika, and we got through SARS, and we got through MERS, and we've had similar but yet dissimilar episodes in the past, but always it has been our scientific community that has rescued us. We take it for granted now, right? H1N1, we take it for granted that we get that flu shot and we don't have to worry about H1N1 anymore. We take it for granted because we have some really bright people, brilliant people out there who got straight A's in school and dedicated their lives to public health and finding cures and therapies. So that's why I think, your question is a good one. I don't know that it's going to be short. But I think based on past experience, it's going to be short. That's my forecast. It could be wrong. I'm an economist. I probably am. Any other questions here? Yeah.
Purely to the virus, but you also said it's 15 years of, however many years of an upturned economy. Talk about, address the underlying fundamentals and how that'll help the V.
Right. So the question is, look, I'm attributing the recession to the virus, but there are broader issues. Yeah, I'm attributing the triggering event is the virus. It is what uncovers or unearths the fundamental fragilities and weaknesses of the economy, because these emerge during every economic expansion cycle. So in the 1980s, people will remember that it was overbuilt commercial real estate and the vulnerability of savings and loans. What was the vulnerability there? The 1986 Tax Reform Act, as it turns out. Because prior to the 1986 Tax Reform Act, you can take your passive losses as an investor against your active gains. So if you were a physician practicing in the heyday of private practice and making $250,000 a year, all you had to do is find an oil and natural gas partnership or some hotel or office building that lost money, and you could take your passive losses in that investment against your active income. And at some point, the office building would turn it around, the oil and natural gas partnership would start kicking in income, and so you'd have to find a new tax shelter that was generating loss to offset that income. But what happened was that many people were constructing commercial real estate to make money, and some people were constructing it to lose money. And what you get? Too much commercial real estate. At the same time, you have a bunch of inexperienced lenders at savings and loans making loans supporting this kind of activity. So that was a fragility. 1986 Tax Reform Act, you might remember what happened to the stock market in October of 1987. Gradually, there are several events, as it turns out, that chisel away at that weakness. By 1990, 1991, we're in recession. Same thing. If you want to find a cause for the 2001 economic downturn, what was that? That was Y2K. Prior to Y2K, what was the issue? Computers, for some reason, could do all these astonishing computations, but could not read the year 2000. That confused them. They could get you up to December 31st, 1999 for some reason, but the year 2000, confounding. So we had to engage in all this purchase of new technology. And at the same time, the dot-com bubble is forming because the internet is coming into our lives for the first time in a real way. Y2K hits, investment technology falls, dot-coms plummet, March of 2000, by 2001 we're in recession. But I could point to one thing, Y2K, that caused that recession. The fragility was broad-based, excessive investment in dot-coms and the technology sector generally. And so what was that recession? It was short and it was vicious. Vicious with respect to what? The technology sector and asset prices. That's exactly what I think this will be. But we would not have a recession at all if we were not so vulnerable. But we are vulnerable. And I've talked about the fragility. And that fragility has formed over, as it turns out, the lengthiest economic expansion in American history. We would have approached year 12 of the expansion in June. We'll fall short of that now. As I say, I think the recession's already begun. There's a question here, and then I'll take you. Yes?
I might have selective memory, but I don't recall an industry like the travel industry being as dramatically impacted by past viruses. Am I wrong that like airlines, cruise ships, hotels, all that stuff were not as dramatically impacted on past ones, and we have a different situation here?
Right. I would agree. No, I think you're right. I would say that there was a period after 9/11, which was in 2001, and then we had SARS, was the 2002-2003 episode, when travel really was very much compromised. The thing about it is, with SARS, the infection rate in the U.S. was very low. It was actually quite high in Canada, as it turns out, but it was very low in the United States. And we're a quarter of the global output. And so now this is affecting the largest economy in the world. We're the source of much of the world's demand. So when we shut down, the rest of the world shuts down. And then when the rest of the world gets weaker, there's a feedback loop there that's, as I say, quite problematic. So, but no, I don't think you're wrong. I think it's amazing how we're responding to this. One player in the NBA, Rudy Gobert, was diagnosed with, and maybe he's really two players because he's 7'5", but one player got diagnosed with coronavirus, they shut the entire season down. You're finding universities where one person has it, they shut the entire university down. I've never seen anything like this. And so I'm not saying we're overreacting, but we're scared. And it's a little surreal, isn't it, to be alive right now? It's crazy. I mean, it's just this feeling of impending doom upon us. Let's just enjoy this meeting. There was because this might be the last one for a while. Any other questions here? You never know. Any other questions from this audience? I thought there was one more, but maybe not. Oh, there's a question right here. This gentleman, as far away from the microphone as possible. No. I'll repeat the question, I promise. Right. The question is, where do I think we're headed with the stock market? It's very difficult to know. I was actually speaking to my father about this yesterday, and I say that because he's the best stock market investor I know, as it turns out. A physician, but just killer stock market investor. Just really knows how to pick them, and timing is fantastic. And we agreed that the Dow Jones, which was almost at 30,000 a few weeks ago, this is my forecast, will ultimately be below 20,000 on the Dow. That will lose more than 33% of the value. I could be wrong, of course, but I think investors have been slow to wake up to how serious this is and how much economic activity is about to shut down. Is it surreal? And the algorithms, they've never dealt with anything like this. The algorithms don't have any underlying data that tells them what an episode like this could be like. This is unprecedented. And there's a temptation to try to simplify this and say, oh, it's like 2008, or it's like dot-com bust, or whatever it is. It's like 1987. It's like nothing else that I've seen in my life. And so the financial markets are going to do what they're going to do. And it's very difficult for them to price right now when they don't know how many quarters of impact there's going to be. I'll give you an example. The CEO of Abercrombie & Fitch, Abercrombie is based in Ohio. At the beginning of this, said, this is going to be bad for our first quarter. And now what is he saying? This is going to be bad for the next 6 months. And so people are waking up now to say, oh, my goodness, this is going to last longer and be more violent than we had thought. So that's my best guess here. And I've been saying for quite some time to folks, raise cash, raise cash, raise cash. That was before coronavirus. And now here we are with all that fragility. Yeah. Any other questions? Yes, sir. Right, so the question is, do I see the rising corporate debt ratios affecting some industries more than others? Oh, yes. So often what happens, we have a lot of junk debt out there. the rating agencies can't rate the debt, and we have a lot of triple Bs and B minus debt, so on and so forth. That's just one downgrade away from being junk debt. But junk debt has performed very well in recent years. You know, it's been one of the better, because everyone's looking for yield. And delinquency and default rates have been low on that debt because the economy has been good. Where we really see this a lot is in the energy patch. So this natural gas and oil companies, many of them are small. Some of the oil companies, obviously ExxonMobil, so I don't worry about BP or Total or something like that. But there are going to be a lot of energy companies that are about to go bankrupt. They just live from hand to mouth. And natural gas, as I say, is below $1.80 per million BTU. Oil at around $31 a barrel in North America this morning. And they're going to go. And, I mean, that's, you know, that's not awful for capitalism, is it? You know, because what happens is that frees up capital now for new ideas to be funded and so on and so forth. And maybe capital flows to stronger players. But that's one of the sectors. And then obviously, if you think about restaurants, the typical restaurant, people say people live from paycheck to paycheck. The typical restaurant owner that I know lives from payroll to payroll. They just make it barely, each and every week or 2 weeks. And you have to imagine, I mean, I've been going around restaurants, and it's been pretty empty. I was on a Southwest flight 2 days ago to Orlando, empty. I had the whole row to myself. And now that might have been because I don't know. But I think other people had the whole row to themselves. It wasn't just me. So, yeah, I mean, what can I tell you? There's a lot of debt in corporate America, but some sectors are worse than others. And restaurant sector, watch out on a sort of a small, C Corp kind of basis. S Corp kind of basis or LLC kind of basis. And then, among the C Corps, the energy patch will create a lot of bankruptcies. And by the way, final point, last year was a record year for store closures in America. Retailers are really indebted and in trouble, a lot of them. So watch out for a lot of retail bankruptcies too. And we've already seen a lot of those. Any other questions here? We have time perhaps for one more, if there is one. Going once? Yes, madam. She's from England. Wait for it.
What are your thoughts on the economic impact of Trump's decision to cancel flights into the States?
Right. So, what I heard yesterday was Donald Trump saying a couple of things, and then a couple of things that he took back, as it turns out. So he announced that, these things are fluid. This is not easy stuff. I would hate to be a governor right now, or mayor right now, or a president right now, trying to make these kinds of life-altering decisions. This is tough. But yesterday what I heard was he is stopping for 30 days travel from Europe to the United States for foreign nationals. So if an American citizen and you happen to be in Italy or wherever you happen to be, you get to come back home. And such restriction has not been extended to the United Kingdom, as I understand it, or at least Great Britain. But yes, I mean, that's and then what he also said was that we're going to stop the flow of goods from Europe. And that's the part he took back. So the markets just tanked when he said that. The pre-market activity was dreadful. And then they walked it back in a tweet, as it turns out. Because that's how we communicate these days. And so major public policy issues. So what can I tell you? The global trade was fragmenting before. It'll fragment even more now. European economy was weak before. Can you imagine how weak it's going to be now? The engine of the European economy is the German economy, fourth largest economy in the world. The chancellor is saying 70% are going to be infected. So you can imagine in Germany right now what life looks like, empty streets, so on and so forth. And so Europe is going to head to a deep recession. Obviously, Asia already in a quite deep recession because the epicenter was originally China and South Korea. And now that's affecting North America. We're the last bastion in some sense. Even Tom Hanks and his wife have coronavirus at this point in Australia. So no one is immune, not even Forrest Gump. And so it's going to get bad. And the president's going to make more announcements saying, this is going to stop, that's going to stop. Because the president seems to think this is a foreign invader. And to a certain extent it is. But it's becoming a domestic issue. And we'll just see how far this goes. But it's unprecedented. It's surreal. I hope to see you again next year. Thanks very much for the opportunity. It's been a privilege.